Now, guys, I have some important questions. Since you guys are mortgage guys, I figured you'd have some really good input on this. Are you pro-vaccine or anti-vaccine? No? Okay, let's try an easier one. 2020 election, was it rigged or was it legit? No? No comment? Okay, well, let's get back. There's a lot of debate going on right now. What is the fundamental difference between a Republican and a Democrat?
Kyle, you want to take that one?
No, it sounds like it's right up your alley. What you were saying earlier.
Oh, yeah. Well, no.
Okay.
Let's.
So a lot of your clients have kids in school. Critical race theory is good or bad?
Man. This wasn't in the
Okay, all right.
Yeah, well, we might be on the wrong set here.
Okay, all right. Welcome to the Time and Money Network Holiday Edition. And look at what we go through for you guys. Look at how ridiculous we look just for you. And I'm here with Brian Tutt and Kyle Wilcox of Fairway Mortgage. What's up, guys?
How's it going?
Doing well. How you doing?
By the way, this is what we wear just about every week.
Yeah? This is the way you dress every day in the office?
We try to.
That's why you're so successful.
That's absolutely right.
It's amazing. Now, we did a podcast, 2 months ago, 3 months ago? It actually was our first podcast, and we'll put a couple clips or links, and you'll see how ridiculous we looked, because the table was about the size of a napkin, and it was shot in a green screen, so we looked like a 1990s where there's a will, there's an A infomercial. Remember?
Man, I was so impressed back then. Now it feels...
I thought we looked good.
Yeah.
Oh my
it
God.
seems so impressive.
I just walked in, I said, okay, we'll just wing it. We'll just go with it. All right, let's talk about mortgage.
All right, let's go.
Is that what you got? Okay,
Yes.
well, let's
We can
keep
handle
it.
those.
It's Christmas.
That's
We got to keep
absolutely
it
right.
nice and simple. Okay.
Absolutely.
So mortgage industry is on its heels right now. All the mortgage guys are pretty much sipping coffee like Office Space, looking at those, what is those, PCS reports or something, right? They're cutting fish in their cubicles because there ain't nothing going on right now. This 6-month period is a transition period between the news cycle and the gravy train that all us real estate guys were in. So we're going to talk about what's real, what's actually driven by the media, what's the fear-mongering versus what is the real data. Now, listeners, be very careful because these guys are mortgage guys. They're going to be a little bit optimistic about the future of the real estate and the mortgage guys. Sort of like a candy store owner who says diabetes isn't real, right? So you got to be very careful. Just take the facts. And again, we're not financial advisors. These are all opinions of this show, but they're going to be talking about what they think 2023 is going to be for the mortgage industry, a little bit of the real estate industry, and I'm going to be the devil's advocate, which is a very favorite position of mine. So what is the current state of the mortgage industry as all these people are in the sand traps and not in the fairway?
Well, yeah, and we're not looking at this situation through rose-colored glasses.
Rose-colored glasses.
I think we're basing this off of what we think is historical trends and data. So we feel pretty comfortable about that there's good news coming.
Outlook looks very positive.
Oh, that sounds rosy. Let's get behind what's real. Okay, so tell me the number one thing you think that consumers don't know about 2023 real estate.
2023 real estate?
Yeah, 2022 is over.
Rates are coming down.
Okay, let's talk about that. Everybody thinks, I've heard people say rates are going to 10% and 12%, but this Barry, what's his name? Barry Habib. Okay, I watched that content, and not to sound conceited, I wasn't the smartest guy in the virtual room for once, and I loved it. This guy is smart. He gave me all kinds of data points I didn't even consider. So let's talk about why our rates may be coming down in the first half of 2023.
Well, the first thing I would say is that the rates are up artificially, and we're trying to get a hold of inflation. right?
Sure.
We can go into a whole diatribe of how we got here.
What's the
but
word diatribe mean? I don't even know what the word.
We can go into a long explanation of how
Okay,
we got here,
thank you.
right? But let's save the time, right? But the inflation is up. They're trying to curb that, right?
Okay.
Artificially. There's news coming out that they might be getting a handle on it. So what happens is rates do follow inflation. And so when inflation comes down, rates historically will come down.
Okay, why?
Well, essentially, that's because that's the way that's how Fed controls inflation, is they make the cost of borrowing money higher or lower. And so when inflation goes down, that's because the Fed has lowered the cost of borrowing money. And so
Right.
there's more people in the market.
Yeah, and guys, listeners, money is a product like anything else. A widget, these moose glasses that we bought, money is a product, right? So you got a wholesale cost and a retail cost, just like any other product. And to my knowledge, the Fed deals in wholesale rates. So this is the interbank rates between one bank to the next, or the Feds to the bank. And what they do is they use this to, like a volume knob of liquidity, right? Mm-hmm. So when there's inflation, let's talk about what is inflation. What's your definition?
Inflation is where the cost of goods go up because everybody's spending, and the demand and the supply is dwindling. Right. Demand is overcoming the supply.
Too few goods and too much demand.
Correct.
Too many
Correct.
people chasing too few goods.
Yep.
Just like the toilet paper of 2020,
Oh,
right?
goodness.
Absolutely.
What was up with that?
You did watch the video.
I did. I watched the whole thing. I couldn't stop watching
Yeah,
it.
absolutely.
Yeah. So look, when there's a shortage of toilet paper, people get crazy. It's something they need. Prices go up because there's too few goods and too many buyers, right?
Right.
So what happens when you print trillions of dollars and flood it into the market, and then nobody wants to work? I think one thing Barry didn't touch on is that, to me, it's when you're... Here's an interesting metaphor. I'm going to go off topic, right? Name me one animal on this earth that eats when they're not hungry. If you're not hungry, you're not going to eat.
Kyle's been called an animal before, but
Okay, so let's take a look. Why would somebody who's just been given 20, 30,000 of PP money, why would they want to go and produce a product? Why would they want to get in their car, drive to work, deal with the bosses, deal with all that stuff? Why would they want to do that when they have all this Netflix and social media to surf at home, right? So what happened to me is we had this limited labor float and then supply chain issues. You couple that with a bunch of people with a bunch of money and nobody's producing anything, you're going to get inflation, right?
Correct.
And now inflation's starting to come down a little bit, but we have to get these people back to work. That's my theory, right? So in 2023, what do you think rates will do in accordance with inflation? So inflation will taper down, but let's figure out, why does rates follow inflation? And Barry commented on this. Do you have any comments on that?
honestly can't remember what he said on that.
I do.
Do you remember?
It was really good. All right, let's bring up, that's why I wanted these slides, because I just watched this once, but it was so much good content. And that's not it. Let's find this. Okay, so basically, inflation and rates have a correlation. So every time inflation goes up, rates go up. Why? Because I just said it, it's a product like anything else that has a supply chain. Money has a supply chain, right? So when inflation goes up, so does the cost of money. And when inflation comes down, so do the rates, right? Because it's a product like anything else. And what happens is, if the Fed has the volume knob to liquidity, and they have too much money in the market chasing too few goods, do they want people getting more credit and more borrowed money?
No.
No. So what they do to try to discourage that is make the cost of that money product higher, right?
Increase rates. Yep.
But then it decreases the volume knob, and then there'll be less people chasing those too few goods. So there's more toilet paper than toilet paper buyers, and those prices start to come down.
Yep.
So that's all they're doing with the Fed, is they're using it as a volume knob to create liquidity surges or restriction.
And so since March of this year through December, we have seen the highest increase in mortgage rates historically than we have ever seen in the past.
It's amazing.
400 basis points, right?
Right.
And so what has happened to housing demand?
Of course.
It's basically come to a halting stop.
Right.
And so now, I think that the The supply issue is helped, and so now we need to lower rates, and which we're expecting June of next year probably, and that's going to ideally get more demand for those houses.
Right. Well, here's what Barry didn't comment on that I would love to have a conversation with this guy because he's really smart. But let's talk about the housing market because that's the industry I'm in. Mm-hmm. Now, have you noticed or seen the lumber prices and commodity prices all going up and up and up?
Correct.
My theory, and it's just an opinion, is that some of the major causes of why real estate has gone up so much is not the house so much and not the demand so much, but the bricks, the lumber, the windows, the labor. So if it costs you 28% to build a new house more this year than it was last year, well, what is that going to do to existing home prices?
It's
going to go up, right?
Yeah.
Because their lumber, like I made a joke when I had all these rentals before I sold them, is like, these rentals aren't going up. The lumber, the windows, the doors, the labor, the handyman, the cabinets, all of that's going up. I invested in wood, really, is what I did. And you couple that in an inflationary environment where commodities are going up with the cheapest money possible, and everybody's at home sick and tired of their house and they want to upgrade their house. That's a perfect storm for the last 5 years.
Right.
So what I'd like Barry to comment on is as supply chains open up and demand comes down, well, those commodity prices are going to come down, which means in 2023, it may effectively be 10, 15, 20% cheaper to build that same new house as it was in 2021. So if that new house is 20% less and the existing home was pegged up, what's going to happen to existing home prices?
They'll go down or stay flat.
Okay.
The variable there is this new millennials, right? This new buying population that's coming into the market.
True.
That's going to require you to build 1 to 2 more houses than that you were last year. So although the material may come down, there's going to be higher demand, we think, because of this new population of home buyers that are coming into their buying age.
Right.
And so it's just, again, it's all about supply and demand. You've got more demand entering the market. We think it's going to be the perfect storm to continue to drive up.
And Barry's arguments were so enlightening, right? Because, the media, the fear, I can't say that fear P word, but the fear mongering that's happening. There's a new poll that I just read that 40% of buyers think the housing market is going to crash. Mm-hmm. Well, those 40% are definitely off the table. So if you take higher interest rates, less inventory, and you take 40% of the buyers off the table, well, that's a recipe for exactly what we got, which is stagnation. Mm-hmm. Real estate market's not necessarily bad right now, so what if it's dropped 8% or whatever? That's the ebbs and flows are normal. What is bad, though, is nobody's creating transactions, right? So you have 50,000 agents in this city and 2 million in the country, and you got all these mortgage guys sipping their coffee wondering, hey, 2023 is going to be the year, but let's figure out why.
Absolutely.
So let's comment on the most fascinating part of this presentation that you guys made me watch, which I'm so glad you did, and something I never even took into consideration, which was household starts. So how are households created? And I bet nobody in this audience, or maybe they have, has ever considered the real estate market compared to housing formation or household formation.
Yep.
What does household formation mean?
So just think of your own household, right? You've got kids, you've got a family, your kids are growing up. As they become of age, 18, 20, 21 years old, they want to go off and create their life, and so they are leaving your household. A new family is being formed, and they need a place to live. And so that's what's happening, is a new household formation is a new population of people that need places to live. Right.
So all the you ever seen that YouTube video, Adopt a Millennial?
No.
Oh, it is hilarious. For $2,500 a month, you too can have Tanner, the millennial. You can adopt him, right?
I've got enough.
So we gotta, what was so funny is all those kids in the basements and mama's basements. You'd think it was 23 or 24, but what did Barry say the average age was before they leave the house?
It's 26 to 34, and 34 is the average median age when they buy their first home.
Yeah, it was. Right. I think it was 33, 34.
34, yeah.
So it's 30. So anybody who's got kids and think it's going to end at 18, well, the stats say it's 33.
Correct.
They're going to be with you until they're 33 years old.
Yep.
That's amazing. Okay.
There's 72 million of them coming, though.
Right. So that was the most amazing stat that I've never even considered, and I've been super enlightened. I now know what I didn't know that I didn't know, which is our whole theme here.
Yep.
Is that in comparison to the 2008 crash, there was a lack of 33-year-olds that were born 33 years prior to 2008. And we have a chart here, and I think our editors will put it up, hopefully with Barry's permission. I don't know if we need the permission, but it was an amazing enlightenment because it showed the supply and demand curve for household creation from 33 years before 2008. And what happened 33 years ago? What's 2008 minus 33? Anybody tell me that year? Anyway, we'll get it. Whatever that
offset someone, not us.
Whatever that year was, that year range, there was a dip in 33-year-old births from 33-year-olds in 2008. And I'm like, oh my God, that was so enlightening. What year was it? 75. Right. So from 75 to 78, there was like a birth dip.
Yep.
And then you take that and you correspond it with the data of 2008, where you have builders building way more houses because it was easier to find labor back then. Then you have these 33-year-olds that didn't exist, so household creation was non-existent almost.
Yep.
Then you couple that with mirror loans, and mirror loans is an old joke where if you could fog up a mirror, you'd get a loan.
Yep.
You don't have to, you just have a pulse, right? Doesn't even matter. That was the perfect storm for what happened in 2008. We got low household creation, we have way too much inventory, and we have loans that were bad.
Absolutely.
And he had mentioned, too, that 2008 was the only recession that was caused by housing. Usually, the recession, I forget.
Housing stays strong through recession.
Yes, usually housing stays strong. That was the only way. So right now, in my opinion, and it's just opinion, I don't think it's going to be at the magnitude of 2008, but we still have challenges.
Well, let's talk through that. So you got, and we've seen, and you'll post the stats, lowest inventory, right? And obviously we talked about how COVID kind of perpetuated that. People had a lot of money. You had a lot of investors, cash buyers coming in, buying up all the market. And we talked about housing formations and builders not being able to keep up. So very low supply. You just talked about the millennials. And that what really resonated to me is what was the biggest population for as long as I know before millennials? The baby boomers.
Yep.
Right? World War II, all of a sudden our parents come out and there's a lot of them. And that was the longest one. And then now, last year, millennials popped up. That resonated with me because I've always known the baby boomers being the biggest population. They're going to, Social Security is going to go away by the time I get there because of them and so forth. And now you got this next biggest wave beyond them.
Yes,
coming.
and it's in the charts.
Yes.
So 32 years ago from now, there was a ton of births. People were getting busy, right? And now, when we're entering into 2023, 2024, it's hard to build houses. So if it's hard to build houses, that means they've learned their lesson from 2008, which basically means there's going to be less new homes built, and we have all these household formations. So that will create a balanced market. So that's why I think the magnitude of this correction will not be like 2008, unless something else geopolitical happens. Of course, wars can happen and anything can happen, right? So we're not promising anything, but I think when all the smoke clears, I think we're looking at a 10 to 20% correction at some point in the next 18 months, just from pure logic. Do you guys want to argue that at all?
No, and when you say correction, what does that mean to you? What are we correcting?
That means that $400,000 average house is now $380,000 or $370,000 in America.
Why would you say that? So I'm curious about that.
Well, you're talking nationally, right? Not locally.
Nationally.
It doesn't matter. Like we just talked about before the podcast with marketing, its equilibrium will always find itself. Now, there is a caveat I want to mention.
Okay.
Builders don't build entry-level homes. Why?
Less profit.
Well, less profit, but there's a bigger reason. Land is so scarce, right? So when they're overpaying for that parcel of land, they got to build up. They can't do these little entry-level rental single families. That's why they're so hard to find. So I think housing trades differently at different price segments. Like when I buy rentals, I love the cheapest house because they're great rentals, little single story. It's a high demand for rentals, and people can't replace that easily because builders are building these monstrosities because they have to build up for profit margins, right? Where was I going with that? I was asking you a question.
Oh, the correction.
Yes. So I think pricing, housing trades differently at different price segments. The biggest risk to me in DFW is your $500,000 to $800,000 price range. The super rich, the $1 million houses, they don't care. They can figure it out. The entry level, there's that problem with building those entry levels. So we have an inventory shortage, and interest rates doesn't affect their payments as much. It's that middle America, that $500,000 to $800,000 price point, that's most vulnerable to this correction, in my opinion.
And you're primarily saying that because the cost of building material is going to be cheaper, so therefore the starting sales price is going to be cheaper?
Well, there's two factors. Number one, we're all drunk on 3 or 4% 30-year mortgage rates. Completely drunk.
Right.
Yep.
Like even 5 is a shock to the system. So even if they come down to 5, that's still a shock, right? Number two, as things slow down, you're going to have all the commodity prices, like lumber's already crashed. We have oil's come down, even though it shouldn't, because of recession fears and the fear of demand. So when it's cheaper to buy a house and nobody's building houses, all the labor is available. So how much labor has built up in the last 5 years? How many tile guys are now contracting with builders and all this labor, because everybody wants labor, so they have cultivated all this labor. So imagine in a moment where interest rates are up, commodity prices are down, and labor's plentiful. How cheaper would it be to build that house?
It would, but it's all about the demand. That's the question, is are the builders going to have the foresight to understand that there's not a lot of options out there for people to buy a home anymore, right?
Okay.
And they do have a captive audience. So are they going to be able to capitalize on that to say, hey, look, we don't have to. We can make bigger profit margins, keeping the prices the same, or maybe even driving them up.
That's optimistic.
It is optimistic.
That's the candy store owner talking.
Yeah. Well, there's my glasses.
Do you believe that rates are going to come down to
Yes.
Okay. And so I think there's a stat that says between 5% and 6.5% to 7%, you lose 15 million borrowers through qualification. They don't qualify for the house. So when that rate goes down, forget the psychology. They just qualify now. They would buy now probably, but they don't qualify. So
Let's look at this year. Back when rates were 5, it was still slow as molasses. So from 5 to 7 had no impact whatsoever on demand.
sticker shock, right? We were in the shock from the frog in the water, and it takes a while before.
Here's what I'm saying.
From 7 to 5, so people are going to.
As people go online, they start searching, right? There's always this dilemma. Do I buy new or do I buy existing? Because existing's easy because it's there, but at certain price points, like the 500,000 to 800,000, it's not going to have the tile you want. The wives aren't going to be happy with it. They're going to make sacrifices. You can build a brand new house exactly the way you want it. Well, if the limited commodity, the commodity prices and the limited labor supply has caused existing homes to raise, but now all of a sudden it's 10, 20% cheaper to buy a new house, what would most people do? Buy new or existing?
We buy new.
Okay, well, that new house sale becomes a comparable for the existing home market. So it has to pull it down.
But you're making the assumption that the builders are going to keep the prices low.
Well, the average builder profit is about 20% on custom homes. D.R. Horton, and I don't work for D.R. Horton, but I think they're about an 8 to 12% net margin at the end of the day. Do you honestly think they're going to just decide to keep 20, or do you think they're going to be business as usual? Because all it takes is one builder to maintain the normal margins, and all the other margins are going to have to come down. That's the thing.
Okay.
That's the thing, right? So imagine you have 5 builders, and this guy can do 30% margins, maybe, but the other 2 are saying, well, we're going to take the market, we're just doing our normal margins, and all the flow goes their direction, so he has to come down. That's the problem with a commoditized product. So,
But D.R. Horton, and I don't work for D.R.
Yeah,
Horton.
we love D.R. Horton.
Yeah, we love D.R. Horton. But they typically are more of an entry level, right? Yeah. So the thought is are people going to leave their current house to go to entry level, or are they going to upgrade, right? And if they upgrade, are they going to go to maybe a more customized house?
Right. Well, the custom margins are 20%.
Correct.
What I'm saying is it doesn't matter what segment it is. If you have 3 custom home builders and 2 guys decide to get greedy, and then one guy says, okay, well, they're greedy. I'll just buy the market and I'll sell all these houses at my normal margins. These guys have to come down. That's the problem with commoditized things. Custom home is a commodity.
Sure.
There's many of them, right? You can buy them in various locations, just like an Amazon widget. So imagine somebody's selling these silly red glasses on Amazon, and let's say there's 14 of these sellers, and all of a sudden the demand for silly red glasses is through the roof, and you want to take the market, what's the first thing you would do? Drop the price.
Well, yeah.
Right?
Undercut the.
And what's the next guy got to do to compete with you?
Undercut the competition.
That's right. So that's what happens. It's the
or
equilibrium just
niche,
happens,
right? Or they find another angle to sell,
sure.
right? So maybe they fold up into your pocket or something like that, right? So it's just, and obviously we're talking hypotheticals because we don't know, but I love the conversation because it gets you thinking. I personally think the values are going to stay strong or go up just because of the fact that within our market. Nationwide, sure. I think maybe 4 or 5. I don't even know if it'll be that high as far as increase year over year, but we'll see.
Only time will tell.
Yeah, but in our market, what we're seeing is new home buyers, right, coming in at that normal price point of anywhere from $250 to $400, and the current values are. It depends on where you want to go, right? They're roughly around there, but they're going to buy mostly existing, and then people leaving the existing homes, they're going to want to upgrade, right? They're going to want to get the the nicer homes,
sure.
right? And I see that the builders are going. Well, we'll see. We'll see if they have the foresight to say that, hey, yeah, lumber is cheaper, but I don't have to drop my prices. Now, it depends on how long they keep the inventory, because right now they're dropping prices because they have inventory just sitting there.
Yeah, it's not going to happen, man. It just takes one guy.
I think so.
One guy goes to normal margins, and the other have to follow. Otherwise, nobody would sell red glasses except for the one dude who went to normal margins.
Well, I personally haven't looked at the cost of material driving down overall home sales.
That's what Barry was missing, right?
Yeah.
Like, this is the equilibrium.
But I do think we're just maintaining pace with new home formations right now with building, and it's not that they just can't keep up because there's still a material shortage, right? They're still trying. People just now going back to work from COVID, and so we do think that lower rates is going to cause if nothing else, 15 million more qualified buyers that could have bought to be able to buy, whether they buy or not. And then you personally, I think you have a inventory shortage because you can't keep up with demand now. Barely, you're just keeping pace. A new population of buyers, existing qualified buyers today that will now be able to buy because now they qualify.
Right.
It feels like the age-old supply demand. You're going to have more people wanting houses and not enough houses to fill them, and so I'm sure material costs are going to catch up to that soon too.
You look so smart in that suit. You're so smart.
One fish, two fish. One house, two house.
Yeah, and it's nice to be romantic about things because I want this gravy train to last forever. But we have to be real about it. And I think, the summary is going to be, yes, rates will come down because they're paired with inflation, my opinion. And that will make a manageable market. That's our goal.
Normal.
Yes.
Let's just make it manageable so things make sense again. But on the silver lining, and I'm going to be the candy store operator here for a second, there hasn't been a 10-year period in the history of real estate where prices have not gone up. Right?
Especially after a recession.
Yes.
Except for 2008.
Right. Even if you bought at the absolute top in the absolute top was June of 2022. I don't know if you were aware of that. That was the actual top. And I sold my house in May of 2022. Just saying. Just saying.
So you left a little on the table.
Yeah, a little bit, yeah. But even if you bought then, if you're not planning on selling this house next week, you should be fine in the long run. Where it really matters is investors, and we're going to talk about that in a second. Because being a retail client and getting a 30-year Fannie Mae mortgage, you have so many options. You could hold that paper for 30 years when nobody does. You could rent out that house, and in 12 months of rental payments, that house no longer counts on your DTI, right?
Right.
Right. So you could rent a house for a year and you could have a full rental, and then you can get another 30-year mortgage. You could do that 10 times on a credit file.
Correct.
Right? Which we talked about last
we
podcast. So you have so many more options to manage a dip in the market. But the question is, do you want Bubba the truck driver to be your next door neighbor? Do you want kids running across the top level of your apartment? Or do you want to own something? That's really the ultimate question. How cheap it is, how expensive it is, it'll all work its way out in the end, right?
Absolutely.
So give me the top 3 reasons why somebody should buy a house with you in 2023. Give me just one.
Future wealth.
Future wealth.
Future wealth.
Okay.
Leverage.
Leverage. Got it. Let's talk about future wealth.
Well, the reason is because, again, as we said, and historically speaking, values always go up, right? They'll ebb and flow at different rates, but they'll always go up. And we can show you a model where buying a leverage asset like a home, right, will give you dividends, a higher percentage return than just putting it in the market anywhere.
Yep.
Right.
Let's tell the audience what leverage means.
Leverage means you can buy a house. You take a small amount of funds to buy a
$5,000 down payment.
$5,000 down payment to buy a $400,000 asset.
Right.
You're leveraging a small amount of funds to buy a bigger asset.
Right. It's like a teeter-totter. Is it what's the other word? It's a teeter-totter, or is it what's the other word? Seesaw.
Seesaw.
Is it teeter-totter or seesaw?
Right. Yeah.
Which
Seesaw.
one is it?
Both.
Okay.
Both are acceptable.
I call it teeter-totter. I like
Coke pop.
because I like Yellowstone. I like teeter, so it's
There you go.
teeter-totter, right? You like that segment? That was pretty good. Anyway, so we have Joshua Colson here, which is a large man. Nobody could lift him.
intimidating.
Nobody could lift him up right now, unless we put him on a teeter-totter, and we all got on this end, and that's leverage, right?
Right.
We're using a fulcrum point
Yep.
to lift this large man up, right? So how do you control large assets? The fulcrum point is banks' money. It's other people's money
Right.
that can lift that asset up, right?
That's right.
Now, leverage is a two-sided sword. What's the word? Two-sided sword? Anyway, it's a double-edged sword.
Double-edged.
Yes.
What's wrong with me? Two-sided sword. It's too literal here. Two-sided sword. It's a double-edged sword, right? So the crypto market, using massive leverage, has lost their you-know-what. Three-letter word, all right? But if you did it right back when Bitcoin was, 1,000 and you used leverage, then you're a gazillionaire. So leverage is a double-edged sword.
Why
I'm
is
gonna
real
start
estate
using
different
side
than
of this.
crypto? Why would you say is real estate a safer investment than crypto?
Because real estate has an actual utility. What does crypto do? Can you buy bread with crypto right now? Can you even hold it? Can you physically hold it?
Confuses the heck out of me. I've
It's
never
in the cloud somewhere.
It doesn't have a utility except for the storage of wealth, which
physical. Yeah.
the argument that it's a storage of wealth when it's volatile by 60% is the silliest argument I've ever seen. Your wealth is gone. There's no gold is a storage of wealth to me. Anyway, what we were talking leverage.
assets.
Sorry, now we all know what leverage is. Go ahead.
Double-sided swords.
Double-sided swords. Yeah.
So yes, the wealth, you can take a little bit of funds to buy a leveraged asset that will continue to grow over time, which we do a lot of coaching with our clients on using real estate, not as the entire foundation, but as a pillar to your wealth management. And we think it's a very strong pillar.
Yes.
And we work with a lot of financial advisors, and it baffles me a little bit that they don't look at it the same way, right? But we think that is, you can use, and you mentioned a bank. You borrow money. We put our money in a bank, right? How much do we get return on that?
Nothing.
Nothing. What do they do with that?
They reloan it 7 times over.
And they make all the wealth, right, on our money.
Right.
So I try to say that real estate, you can create your own banking system. You buy a piece of real estate, lease it out, somebody's investing in your bank.
Yes.
Right? You're growing the asset. You're using their funds. They do get a utility. They get a roof over their head. They get a house, that kind of stuff. But you can use this as a wealth management tool by using that leverage asset and multiplying that.
That's right. I used to make a joke that if a bank offered you 6% interest and it only took a few months to get your money back out, you would put all of your money in there, right?
Absolutely.
So that's what a rental property basically does. If you took the average cap rate, which we won't bore you with that, but it just means how much are you making on a percentage basis. It's usually 5 to 6% on a single family rental. Well, if you paid cash for a rental and you rented it out, you're making 6%. Now, how liquid is an entry level rental? Pretty liquid, right? Within a few months, you can get your money. So it's just like a checking account that you're getting 6% on. Plus, you have the appreciation kicker, which you got to be careful, but the average appreciation over time is like 2.5%. So you have to add that to your 6%, so it's making 8.5% yield. So that's the storage of wealth.
Right.
Because literally it's liquid within a few months within reason. What's annoying about it is the toilets and the termites and the roofs and the AC, right? So you want to figure out how to make it passive as much as possible. Passive income's a silly term because it really doesn't exist. But that's kind of like a bank account that would pay you 6 to 8%. Now, why can you get that? Is because you were creative, right? You weren't going to the banks. Why would a bank offer 8% if they can get deposits at 0.5%? They wouldn't need to, right? So you can manufacture yields by doing that.
Thus, growing your wealth.
That's it,
And
right?
65% of the wealth in this nation is borrowed.
I think it's more than that.
Oh, is it?
It's
I
a lot.
thought it was 65%.
I think Barry said 16 out of $17 was.
Okay, maybe, yeah.
I don't know why I listen to this so much. I usually don't listen to this stuff, right?
Join his fan club pretty soon.
Yeah,
huh?
he's a good guy.
Yeah,
he's a
he
very
is.
smart guy. I was enlightened and thought about it all night. Like I didn't even consider some of this stuff. So it took me from the real estate markets collapsing to, okay, it's going to be bad, but it's not going to be as bad as '08 in my opinion.
I agree.
Except for investors. Have you seen Open Doors stock?
Have not. Is it tanked?
Woo-wee. I think it's
Are they gonna be
$1.50 or
closing
something.
the door?
$1.50 or something. Yeah, it's bad. All the major brokerage stocks that I know of, EXP, Compass, their stocks are not doing all that well because the market's forecasting 6 months in the future. Open Doors is a whole other animal. Zillow. You just look at that whole segment. Wall Street is giving you clues on their profitability. Now, why do you think that is? Is because they scaled huge businesses with huge middle management expenses, and they have to overpay for products just to get the thing done. So they're not like they're more like a cruise ship, and they take forever to turn. And us little investors, we're like speedboats. We can get in and out, right?
Yep.
They diversified too much, and instead of doing one thing great, they tried to do a bunch of things, and they did a lot of them.
Well,
bad.
2 years ago they're geniuses, and today,
right.
like.
They're not got in the mortgage game and all.
Yeah, but investors, this is the problem. 30-year mortgages are very difficult to obtain when you're investing in a rental real estate because Fannie limits you to 10, and they're very difficult to get. You paper cuts up the wazoo. A lot of community banks will only do 20-year amortizations, and they want to put you on 3-year or 2-year balloons, which means your rates will start fluctuating. Yep. I know big companies that have bought tons of apartment buildings, and now their rates are literally getting jacked up to where they're going to lose millions of dollars, right? So the key to a rental is having permanent financing, because when do you think you would have to sell the most is probably at the bottom of the market, where your bank does a credit call or says, hey, we don't want to do this loan anymore. We need payment in 90 days. And usually that happens at the bottom. So imagine you have like 25 rentals and you just beat in your chest. You think you're the coolest kid out there, but you didn't realize that you were on 2-year balloons, because that's the only thing the bank would give. Then the market goes crazy down, and then do banks play offense or defense when that happens?
Defense.
Defense. So they said, hey, we want our money now. Well, unless you can get Uncle Buck to save the day, you're forced to sell at the bottom. So the only rentals that I kept through this nonsense are the ones that are on permanent Fannie Mae financing, because you can go up and down, it doesn't matter. That money's always secure.
Yep, that's right.
There's no margin call. But a lot of investors are going to get stuck, because as soon as the banks play defense and not offense, that's usually at the bottom, and there's no liquidity in the market to take them out. They're going to be forced to sell, which will create more inventory, which is good for you guys.
There you go.
So what else? What else should we talk about?
What would you recommend for a new investor? Would you recommend him buying this coming spring, summer?
Depends. What's the situation? Let's go over situational analysis. Let's ask Jason. Give me scenarios, and I'll tell you exactly what I would do.
Okay. Well, you have some of the highest appreciation over the last 2 years. People have over, what is it, 11 trillion in equity in the nation right now, and you got some people that are, as we know, they're doing well, and they want to invest, right? They Time and Money Network has opened their eyes, and now they're like, hey, I want to invest. I want to start growing my wealth, right? I want to use that equity. Would you recommend that they buy in the next spring, summer session, hold off a year?
Well, what's the situation? They buy in a bigger house?
Is it better
investment
to today buy a $550,000 house at 6.5% rate with low demand, right? People are not, you're able to negotiate, or is it better to wait, get a little better price on the house, $50,000 under asking price, and pay 5% interest rate?
Well, it's like catching a falling knife. So first, if you're going to do that, you have to have the equity piece. And what I mean is, if you sell it tomorrow, you have to have $20,000 or $30,000 that you would make instantly. That's what a lot of these open door companies, and Open Door is great. I'm not dissing Open Door, but they're buying over market, so they're missing the equity piece.
Right.
So imagine you buy a full price rental just because you want to get in the game. And let's pretend you're making 5% yield on that rental and things look rosy, right? Then you get a 10% correction. How many years were you a landlord for free?
What was the correction? How did it impact you?
10%.
But in your lease payment?
Nope, 10% of your home's value.
Oh, I got you.
It went down.
So you're making 5%,
Yeah.
but 10% of the house value went down over 2 years.
Gotcha.
But it's like a stock. You only lose when you sell.
That's true. But weren't you a landlord for free?
Well, it depends on if you're making 6%.
Well, if you're making 5% over 2 years and you lost 10% of the asset value.
Well, in numbers on paper, yes.
Okay, great. So that brings me up to another point.
Yep.
Opportunity is only an opportunity when it's known that it's not an opportunity to the public. I'm going to say that again.
Yeah, I need to write that. Hold on.
Yeah, wait.
Once an opportunity is known, it almost ceases to become an opportunity.
Agreed.
Like, do you know any people who are successful buying investment real estate on the multiple listing service?
I agree with your comment. Yes.
Okay, great. So the number one thing is not just get into the game, but you have to find something that other people don't know about. See, in real estate, inside information's perfectly legal. In Wall Street, you go to jail.
Yep.
In real estate, you get, yay, Jason, right? So first I would figure out how to find homes that sellers want to sell where you provide a service. Don't rip people off, right? Don't take grandma's house away from her, right? But strike a fair deal where there's some equity position. You're solving their problem. You're making a move easier. They don't have to do any showings and stuff like that. But get it at 10% below what you can sell it for tomorrow, and that will cushion you for a 2 to 3 year correction. Therefore, your 5 to 6% yield is true.
Even if you have to borrow the money at a higher interest rate?
It doesn't matter.
Okay, perfect.
Here's the thing.
That's exactly what I agree.
Interest rates for investors really doesn't matter all that much because rents are going to go up in accordance with the market.
Exactly.
Because when we talked about equilibrium, right?
That's right.
If your marketing cost is this, then it's going to spread through the industry. So your rent prices will go up. That's why rent prices are going up right now, right? But more importantly, you wouldn't have to sell that asset if you had the right financing so you can ride through the ebbs and flows. But the ultimate thing people don't consider is interest is a tax-deductible expense. And again, I'm not a CPA. Check with your CPA. It's a tax-deductible expense. So every dollar you spend on interest, you would save 30 or 40 cents in tax.
Correct.
Absolutely.
So an investment interest rate is not nearly as severe as when you can't deduct it. But your primary residence, you can still deduct it. So here's something maybe you want to try when you're presenting this because it wasn't in here. You just ask your borrower, what is your average tax rate? What are most people going to say?
I have no idea.
Probably 28, 30%.
Okay, let's talk
Yeah, income
30%.
tax.
So if I get you a 6% mortgage and you were a renter and now you can write off 6% mortgage and you have a 30% tax basis, wouldn't that effectively be a 4% rate?
Well, I don't know. Yeah, I trust your math, but it does equate to something
Right,
like
so
that.
Well,
Yeah.
no, you'll love this. We'll send you another video. Barry does break that down.
Perfect.
Exactly like that.
That's super
So, yes.
smart, right? So again, and another problem with the tax code is they made these standard deductions so high, so a lot of people don't itemize their tax, which then they lose the interest deduction. But if you itemize your taxes, you can deduct that interest on your home loan and the property tax up to $10,000, I believe it is now, something
Yeah,
like
I think
that.
so.
Right.
Well,
So-
let me take another. So you said if you can get it 10% below market to help with a correction,
Anything,
right?
anything. If how wealth is made, you don't want to speculate on the future, right?
Correct.
Market makers on Wall Street, these Goldman Sachs, these really brilliant guys, are they betting on next month or are they creating transactions or an arbitrage?
That's right.
Okay.
Yeah.
Well, why can't
But-
we do that?
Correct. But my perspective is don't get 10% below the market. Get at market and have them, because cash is king,
Yep.
in my opinion, right? You can get 10% below the market. You're still on an investment property, bring 15% down, right? So that's still money out of your pocket.
Sure.
And you take that into consideration. Why not get at market and get the 6%, 3 to 6% back, right? And pay for the closing costs, more money in your pocket that you can leverage other ways, opportunity costs there. And if you're only going to, as we said, the only time that the market went down after a recession, which we may or may not be in recessionary times. We can go into that, but was 2008 because it was caused by the housing market, right?
Yes.
So if you're playing the historical odds going forward, then unless you're going to be looking to cash out in the next year or two, I'd say go at market with the seller credit. That way you keep more money in your pocket. You'll still be the 5-6%. You can also, as you did your calculation, get down to a 4% if you want to do the math. And keep it, right, for 3, 4, 5 years, right? And then you will come out ahead. I think the concern or the opportunity cost if you don't buy now is if you start trying to invest when the rates go down, right? And you can always refinance when they're, and I think we talked about that last time too. You can always refinance when the rates go down. But if you wait till the rates go down, now you're into the market just with everybody else.
That's true.
And you might not have the opportunity to get free money, as I call it, of seller credits, right? Which means comes out of your pocket. And the way we kind of coach our clients is we want you to put the least amount of money out of your pocket into your investment, right? Because if you, and you know the math, if you put an extra 5% down, you don't get the benefit of that. That break on your payment, break even is 15 years. Put an extra 5% down and you save money that you might make back in 15 years. That's not good, right? So put as little money down and capitalize on that. And then now you're a little bit more cash rich, as long as you're not, even with a 10% correction, as long as you're not looking to just turn and burn over the next 2 years, keep it. And then you do I know you don't like passive income, but you have passive income. You'll have a high propensity to gain on the equity. And you can perpetuate that going forward for other properties where you can, once that equity starts accumulating, right, and have somebody else put money in your bank, paying the mortgage for you, buying down the balance, then you can sit there and you can look to use some of that leverage asset to go buy another one. So I'm under the school of thought because of that it is good even for investors to buy now and do it at, and I always like to say market price as well.
Isn't it? Aren't you? Yeah.
Do you consider me a halfway intelligent guy?
He's saying the same thing.
Are you?
Yeah, I'm not buying anything.
Oh, you're not buying anything.
Yeah, well, that's what I was saying. I don't think he's buying anything right now.
I got you.
Well, why?
Well, all things give equal is what I was comparing, right? If you were going to buy,
if you had to.
Yeah, if you were going to
now
buy.
Let's take about situations of have to, right? And here's the situation of the current market. How many people who didn't have to bought before in the last 5 years? Lots.
A whole lot.
Right. But now the mentality is only buy when you have to. So people moving state to state, bigger jobs, have another kid, That's what's created the suppression of transactions because everybody's wait and see mentality.
Correct.
Right?
And what does Warren Buffett say?
I don't know.
When there's fear in the market, he runs to it. There's opportunity.
But
but I know the opportunity only exists.
No, that's a good statement. But you know what the most powerful thing Warren Buffett has ever said to me? Not to me, but
I was going to say
that resonates to me. That resonates to me.
There you go.
He said that when the tide goes out, you'll finally know who's swimming naked.
Okay.
So all of these companies where their stocks have gotten obliterated, the tide has moved out, and you see them naked as can be. So in down markets is what makes people really, really wealthy because only the smart ones will survive.
Correct.
So you have to be always, and Warren Buffett also says, what's the number one rule in business? Don't lose money.
Right.
What's the number 2 rule in business?
This is like Fight Club. Don't lose money.
Don't lose money. Or follow rule number 1, right? So if you have to move, those are the only people that would possibly consider it right now. So imagine you're sitting on a 3% rate. Why would you go and buy a 7% rate if you don't really have to move? So that's caused the suppression of transactions, right?
Correct.
So we got value and transactional velocity are two different things that would make mortgage people successful and real estate people successful, right? So if you can, try to buy right. Because let's say, what's your favorite car? Just give me a car. Corvette. Let's say you were trying to buy a 1995 Corvette. And then every time you check Auto Trader, it ticks down $500. Yep. You check it the next month, ticks down $500. What's your natural inkling going to be? Going to be wait till next month.
Yep, it's trending the right way.
Let's see if prices stabilize. So if you bought a Corvette 1 month or 2 months later, you have $1,000 difference. So you have to ask, do I really need a Corvette or can I wait? Well, the only people buying houses are the ones that really need the house, right? Which is going to be problematic for us,
the fundamental
guys.
difference, I think, is the belief that rates are going to come down in 6 months, and we're
They will.
Right. And so that driving up the demand, and then
And no, I 100%
you could buy the
agree
house
with you.
then, or you could buy the house now and get a better deal on it. It's the philosophy.
Right. If it's your primary residence,
That's the kicker for me.
that's cool, man.
Primary residence, you buy if you have to.
You can last, and if you have to buy another house, well, you can turn that into a
Correct.
rent. You got a lot of
Important
options.
distinction, versus investor, absolutely.
Right. If you're an investor, primary residence is not an investment per se. It's a utility. It's where you go through that door every single day.
That's right.
Like, we're building a brand new house, and I already know I'm going to lose $250,000 on this damn thing in the next 2 years. At some point, it's going to be $250,000 less than it is now. Is that smart business? No.
It's an emotional decision.
But it's utility. I've got kids. I've got not wives. I almost said wives. I've
She said right over there.
Oh,
Be
watch
careful.
that shoe.
got kids. I got wife.
Maybe today.
And you know what? If I'm inspired because I'm sitting on this land and looking out to ranch property, I'm going to come up with better business ideas and all of that stuff, right? Mm-hmm. But that's why I sold my house in May, because I knew I don't want to hold 2 giant houses into this downturn. So we're suffering. The guy sitting right here is in a rental, suffering. Why? Because I knew that was the right decision to make, because the delta or the spread was so severe on what we're buying and what we're selling. I don't want to hold 2 monstrous assets into this downturn. So I sold the top, went and rented, and then built this house. And I know that house is going to get crushed in this next year or 18 months or whatever happens, but that's the utility. So when you're buying a primary residence, choo-choo, do you hear that?
I hear it.
I do.
The train's coming.
That's never happened in this podcast before.
It's a bright light. It's future.
Yeah.
Watch out for the horn.
The money train's coming. So, anyway, primary residence, it has an actual utility, right? So, go ahead.
Absolutely. No, you're right.
Yeah.
I'm agreeing.
So whether it's 7%, 6%, 5%, if an unhappy wife, you have an unhappy
Life.
Okay,
Life.
then. So
Yes.
so that's a different animal than investment real estate.
Yep.
So if you're buying a house, your wife's going to be happy, your kids are happy, you're in a good school district, it's the right color, it's the right everything you want. Who cares, right? You're not going to get crushed on this thing, right? But if you're trying to make smart, calculated moves, I wouldn't be buying much in the next 6 months unless you could sell it the next day and make that equity piece.
I agree. And that's why a lot of the people that have homes right now are in the 2 and 3. They're not going to buy a new one for a long time unless it's a necessity, which goes back to the new population that will be probably buying with the millennials.
Yes.
Their new home, so they can actually own something, start growing their wealth.
Yes.
So that's why we talked about a little earlier. That's why we're really focusing on that population, because we
Yes.
see that's the up and coming.
Yes.
And because it is their primary residence, it's not a complete necessity because they can go rent, right? But we're here to educate them on why not go ahead and build and buy and own that utility. They can also build your wealth at the same time.
Right. So check with your timing, guys. If it's 5 to 10 years, great. If it's a transition house, then not so great, right? So just every situation's different. You need to talk to these mortgage experts with these fantastic outfits about what's right for you. Learn these stats, that these are amazingly enlightening stats to me. This whole birth rate thing, I've never considered in my entire life. And I'm now looking at this. And I am more optimistic than I was yesterday because of this report.
What about the suit? That made you more optimistic, right?
It does.
It helped. It didn't hurt.
Yeah, you look like a kaleidoscope. I love the hat, though.
Me too.
How long is that?
It's hot as
Have you
hell, though.
measured
I
that?
can tell you that for sure.
I bet.
I am cooking in
I
it.
bet. Now, why do you have 2 sets of glasses?
Well, this is the rose-colored. It's a prop.
Oh,
just
okay,
to
got it.
demonstrate the point.
You haven't touched your eggnog, guys.
Yeah,
a little bit.
Here we go. Mazel, mazel.
There you go. That was too much silence for a podcast. So you guys are homeowners. I
We
take
are.
it.
Yep.
We are.
And you would say, without prejudice or doubt, that you would buy a house right now and upgrade your home.
That's a different story. If you ask Angela, she'll say yes right
Got
now.
it? Why do you say no?
Well, that's just me personally.
But why?
Well, not from a financial standpoint,
Right.
just from a personal. I don't move. We have a home. It's good.
Right.
It's in a prime location.
Right. But
So-
if you found a house, and let's say interest rates were 2% all of a sudden, and this house was just the magical house and your cost of money was way cheaper, you would move when you didn't have to.
It would have to take a big thing to get me to move, but possibly.
But now you're not moving because you don't have to.
That's right.
Okay, so that's the theme. That's what's really going on, in my opinion.
Yeah.
For people that have houses today.
That's right.
Right.
But again, fundamentally, there's a new group of people that don't have a house today that are going to need a house.
Let's talk about that. So again, with these birth rates, and I won't beat a dead horse, these millennials in the next year or two that were born 33 years ago is a surge of household creation. We have to peel them away from their social media and their video games and their subscription to organic, gluten-free bread delivery service. They're going to have to change that address. We got to get them to buy a house and qualify with these rates. And your position is, since rates will come down to a new normal, and because the inventory and builders aren't building and all these household creations are being created, that it's going to be a stable and safe place to do such a thing.
That's our belief.
All right.
Because, what did you say? It's a utility.
It's a utility, right.
They're not looking to turn and burn. They're looking to buy something that's going to be theirs. They're going to own. They have their own man caves for their Dungeons and Dragons or whatever they want to build. Right? So, yes, absolutely. So then the question is when? And do we want to wait till the rates go down? Because that's when a lot of people are waiting. Or and as we know, builders are taking a little longer, inventory's low, or do they want to have the option today to do it and then just refinance later?
Well, let's also talk about the negative effects of not buying a house. Is that since we talked about transparency and everything leaks through the market anyway, if people who own houses that are renting them out, if their cost of money goes up, their rent prices go up.
That's right.
So your rents are going to go up anyway.
That's right.
So rates go up, rents go up. It doesn't matter. It's all an inflationary effect.
Cost of living goes up.
Right? And if you're going to, stay in that house for a lengthy period of time, you're going to get the tax deductions. You're going to get something you actually like and can design yourself. You never have Bubba the truck driver as your next door neighbor. You'll be able to move when you want, not because your lease is up, and you can build wealth slowly and methodically, which will pay more of those gluten-free subscriptions.
I love it because it's just math. You put the numbers on a piece of paper and it does the work for you. It's just basic math. Most people can see that once you spend the time to look at it.
So guys, listening to the Time and Money Network, where smart business is done, this is where smart business is done. So I want you guys to contact Fairway. I want you to contact them. All you millennials, put down the phone and pick up a rotary phone like we used to do it and call these guys and figure out what your battle plan is. These guys won't bite your head off. They're going to do consultations. They're going to put you on a couch. They're going to put a warm blanket over you and make it sure that they're not going to be aggressive, and you're going to see the ebbs and flows of real estate and the actual facts of when you should buy, what you qualify for, and what your battle plan is going to be. And then when they're done with you, maybe you come to my company, Relo Radar, where we find future home sellers that nobody knows about, right? Because if an opportunity is known, it's no longer a
opportunity.
So imagine finding future home sellers, up to 40% more selection than anybody else even knows about, and then maybe you actually get in an equitable position and find what you want at the same time. That sounds like a good deal, doesn't it?
Phenomenal.
That sounds like a great deal.
So guys, you have anything else to add in these silly suits and look at what we've done for these people?
No, I say Merry Christmas, man. That's it.
Yeah. Oh, yeah. It is the holidays.
It is.
Merry Christmas.
Merry Christmas.
Happy Hanukkah.
Yep.
Shalom. What else do people say?
I dare not even try.
I'm not even going to go down there. Happy holidays. That encompasses everybody who's listening, right?
Absolutely.
So, Brian, Kyle, Fairway Mortgage, the best guys
Give
ever.
us a call.
The one mortgage company I've had that can carry a conversation and listen to my crap that I'm talking about all the time and sit there and smile, which is awesome. That's right. So, guys, thanks so much for watching Time and Money Network. We'll see you on the next podcast, and contact these guys right away. We'll see you soon.
See you.